I know exactly how it feels to have saved some money but have no clue what could be your next move. Let's take a look at our investing platform, for example. NAGA has over 1,000 different assets for you to choose from. So which is the best for young investors? Now, if you are facing the same problem, then this is 5 minutes out of your day worth paying attention to. Hi everyone, welcome back to NAGA's channel. My name is Michalis and I'm the market analyst here. So how can an investor know what a good investment is? Surely there's no such thing as a perfect investment for everyone. And yes, this is true. The best investment will depend on what your requirements and objectives are. But young investors tend to have similar requirements. They are happy to take on a level of risk in order to earn a profit, but not so much risk that the investment can be lost. Of course, investors dislike large fees. They want an option which is within their budget and of course an asset which does all the work for them. So they can do less work on their side compared to other assets. So which is the asset which could tick all these boxes? Well, in most cases, it could be ETFs. An ETF is known as an exchange traded fund. It is a type of investment fund. ETFs are basically multiple assets, for example, hundreds of stocks, which have been grouped together into one fund. It is similar to a shopping bag. It is various items all in one bag. So an investor can invest in an ETF worth 100,000 US dollars, but the fund itself will have different assets. For example, an ETF can include stocks, commodities, bonds, and even currencies. By investing in the ETF, you are buying a small part of the overall fund. Therefore, the cost and profits are shared amongst the investors. You can earn from the value of the fund increasing and dividends which are paid to investors 4 times a year. You can explore all the available ETFs on the NAGA platform simply by clicking on login, clicking on trade, and then on ETFs. Here you'll be able to see all the different ETFs in one place. Let's take a look at the performance of some of the most popular ETFs which invest in indices. The Nasdaq over the past 5 years has increased by 72%, the DAX by 20%, and the French 40 by 31%. So why do ETFs tick all the boxes for young investors? Well, the first thing is that the cost is shared amongst all the investors in the ETF. This means the amount required to invest is substantially lower. For example, the Dow Jones, which is 30 US companies grouped into one fund, costs more than 31,000. But an ETF tracking the Dow Jones is only $317. This is because the value is shared amongst all the ETF investors. The second box to be ticked is that ETFs tend to be diversified. For example, the S&P 500 has 500 US stocks from multiple industries. The last and most important box to be ticked is of course profit and risk. ETFs can technically never reach zero, and therefore investors can operate with less fear of losing all their capital. For example, an ETF may be investing in the Nasdaq, which includes 100 technology company stocks. If one of these companies underperforms or goes bankrupt, the stock is simply removed and replaced with another company. The Nasdaq's worst run over the past 20 years was during the 2007 banking crisis, where the ETF declined by 48%. In total, it took 2 years to regain its lost value and has increased in value by more than 500%. And this is without even taking into consideration all the dividends paid over the past 20 years. So you can see here that investors willing to take a longer term view can potentially benefit from ETFs. However, there are a few lessons to be learned by young investors. Lesson 1. If you are trying to be a millionaire or somebody's telling you that you can double your money every single month, then you are in the wrong mindset. You are being misled, or most probably you will be disappointed. Lesson 2. Investors must have a true goal, and young investors have the greatest advantage, which most of you do not yet realize. This is the benefit of time. A responsible trader in their 20s may have an investment aim of looking to retire at the age of 50 instead of 65, or investing over the next 5 years to build a deposit on their first home. Or maybe somebody who already has a mortgage may be investing over the next 15 years to try and pay their mortgage off early. So we can see here how ETFs can be a great place for young investors to start. It is lower risk, lower fees, it is a diversified investment. Investors can earn from both prices increasing in value as well as dividends, which over the past 20 years has proven to be profitable for long-term investors. But remember, whatever we say here is not financial advice. Always make sure that you do your research before you get into investing. That's all for today. Class dismissed.